Hi, my name is Scott Marmelstein. My group was comprised of Chase Graham, Thomas Debby, and David Collins. We are discussing American Barrick Resources, a gold miner. A little bit of background here. The company was a lead hedging gold miner. The case took place in the mid 80s to early 90s, and we're going to be discussing how their hedging strategies improved throughout the case, and that luck was really only a factor in finding gold and not necessarily in their hedging strategy, and that competitive advantages could be found through acquisitions and financing, which we'll see in their sources of superior performance. The sources of superior performance highlight in blue there that the competitive advantage was found along the value chain in the acquisition and the selling or financing phase of the miner's movement through the developing the mine process. And that exploration was a little bit of luck there surrounded in the green. And that they would just in the mining process, it was just quick. There was no concern for price because, as you can see in the competitive advantage in selling, they no longer needed to worry about whether they should mine or not, whereas other companies at the time were doing that.
Hi, this is Chase Graham, and I'll be taking you through the next few slides of our presentation. Let's start with why American Barrick was hedging at all. There are a number of reasons, and the list here on the slide is no way exhaustive, but these are the most prominent reasons that we saw. The most obvious is to protect the profits from the volatility of gold prices. So the hedging they did here helped to protect them from any downward movements in the price of gold. But some of the hedging that they did hindered or nullified any upside potential if the gold price were to increase. We'll get back to that a little later when we talk about adverse effects. Another reason to hedge their gold exposure was to limit variation in their cash flows. This would allow them to become more effective in their projections for future growth and future projects because they'd be able to see a little more clearly what their cash flows would be expected to be. The next reason on the list here is to appease shareholders and potential future investors. Because American Barrick hedged, they had substantially lower variation in their stock returns and their cash flows, and this is in comparison to their competition who didn't hedge as much or as successfully. This stability that American Barrick had led to the market putting a premium on Barrick's stock because of the more understood expectations of where the company was headed, what the cash flows were going to look like, and so on. This opened up Barrick to a lot more attention from investors and more funding potential for future projects. The last reason on the slide here for American Barrick to hedge was that it increased confidence in their lenders, their investors, and the counterparties to their SDC contracts. The stability of their cash flows and the protection of their profits from the adverse gold price movements allowed for Barrick to receive very favorable loan terms and longer-term SDC contracts than any other mining firms could get. Though many of the mining companies were using the same sort of SDC contracts for their partial hedging, Barrick was eventually able to negotiate for terms much longer than other companies, up to 10 years with a number of rollover opportunities along the way, which is something their competitors were unable to do. Given these advantages, hedging wasn't only a good idea for them financially, but it was necessary for them to expand the way that they did through the 1980s and through the 1990s. They weren't always so active and successful in hedging as they were in the late 80s and early 90s. And that's where we're going to go next, is the evolution and improvement of their hedging program. American Barrick began using pretty simplistic hedging strategies early in the life of the company. Prior to 1986, the majority of the hedging that they did was through gold financing, such as publicly traded gold royalty trusts, bullion loans, Eurobond offerings, and so on. They used gold royalty trusts to receive capital up front and pay out a percentage of the mine's production to shareholders with increasing payout percentages as gold prices increased. They also received loans in gold bullion, which they would sell in the market right away and use for large capital expenditures in setting up or processing of a mine. These types of bullion loans were collateralized by the assets of the mine that it funded, and the loan was paid back with interest in gold production from the mine that it was funding. So eventually, the finance team at the company became more comfortable with derivative hedging, and they began selling forward contracts to lock in selling prices and protect any sort of downward movement in the gold price. These worked really well to plan cash flows and limit that downward gold price risk, but they also limited and stopped the upside potential. So if gold prices were to go above that forward price that they agreed upon, then they're basically selling below the market rate. The improvement began to show as they hedged more of their exposure as a percentage of their production, and they hedged more frequently. They also used more derivatives that were a little more complex, that didn't limit the upside potential so much, but still were able to protect the downside. So one of these was the use of put options and spot deferred contracts, which allowed Barrick to set a minimum sale price for their gold production while allowing the upside to continue to exist. Among their competitors, Barrick hedged more of their exposure and hedged more frequently than the competition, which actually ended up driving their company value and their stock price higher because of the added stability. The SDCs, the spot deferred contracts, gave Barrick an advantage in hedging over their competition as well. Because of their hedging practices and the stability of the cash flows that they had, they were allowed longer term SDCs, as I mentioned in the last slide, and that allowed them more flexibility and options to profit in volatile gold price environments. And that includes rising environments and decreasing environments. So in steady and kind of monotonous bull markets, some of the hedging strategies that American Barrick used were not going to end up being profitable. When using simple forward contracts, a steady bull market would often be able to drive market prices higher than the agreed forward price, which would force Barrick to be selling their production below market value. The put options that they used suffered a similar fate in bull markets because they have to pay a premium up front. The put options only pay off as the gold prices decrease. So even though they're not missing out on a whole lot of potential in a bull market, they are having to net out the costs of the put option premiums and allow those to expire worthless if the market ends up above the strike price at the expiration. The spot deferred contracts were useful in bull markets, just not always in longer term bull markets. If the bull market pushed spot prices above the agreed forward price on an ongoing basis, Barrick could defer delivery at the forward price to the next year. But eventually, if it was a continual upward trend and the spot price was continuously going to be above the forward price, they would eventually have to deliver under the terms of the SDC at the given forward price plus whatever the percentage contango was at the time. And in this regard, long-term bull markets were difficult to navigate using the SDCs. Their hedging practices were limited in their potential gains as the price of gold increased, except in particular cases. Long-term bull markets usually wouldn't serve them as well as a long-term market of volatility, as they saw through the 80s and 90s, where prices were decreasing and increasing dramatically, over that long-term scale.
Hello, this is Tom DeBee, and I'll be walking through the next few slides. In 2012, gold prices were steadily climbing. The hedging program that Chase covered earlier was becoming ineffective from the rise in gold prices. Management of American Barrick decided to discontinue the hedging program to take full advantage of the rising prices. Unfortunately, all good things have to come to an end. The rise in gold prices ended with a sudden drop. Since the company was no longer hedged for moments like this, the company suffered losses and the stock price dropped. Earlier communication to shareholders had been that the company was price hedging and the profits of the company would not suffer from drops in the gold price. It appears that the change in hedging protection was not communicated to shareholders. In addition to a decrease in share price, we would expect shareholders who paid a premium for the company's stock that Chase mentioned earlier to be angry with management for not disclosing the change in strategy. Instead of completely eliminating the hedging program, management should have created a minimum hedging strategy to protect itself against a catastrophic decrease in gold prices. In addition, risk management failed to identify gold price as a risk. So what should American Barrick do in the future? Management should continue to hedge at a minimum level so a drop like I mentioned in the previous slide does not occur again and decrease the profits and the share price of the company. The finance team should project expected EBITDA, gold production, and gold prices. This will help the risk management team determine the correct course of hedging that is necessary. Management should determine the expected level of allowable risk and communicate it to the risk management team. The risk management team would then take this information and would implement the allowable risk. The risk management team should continue to regularly monitor the expected risks and implement any changes to these methods after the risks are identified. Another possibility that management can consider is for the company to become more leveraged, which would lower the cost of financing and increase the value to the shareholders.
Hi, my name is Dave Collins. I'll be providing a summary and some final thoughts for the group. American Barrick entered a competitive and volatile gold mining landscape in the 1980s with no real market differentiator beyond their critical decision to hedge, and that was by design. The founder and chairman, CEO Peter Monk, was a financier and an entrepreneur foremost. He was not a miner. American Barrick had to be good at hedging, crafting forward contracts, and creating innovative ways to remove volatility from the market and remaining an attractive and stable place for investments. The rest of the market could take pride in persevering through market downturns without hedging. They might have other competitive advantages through advanced exploration techniques, highly efficient extraction, or some other operational effectiveness that allowed them to compete effectively. So while American Barrick did secure critical acquisitions that proved to be highly advantageous for them, as we mentioned earlier, this was mostly through good fortune. They held no other sustainable advantage to count on. Everything they did beyond hedging that didn't involve luck was highly replicable within the market. So, the cost of financial stability for Barrick was limited potential upside, but this was their strategic niche. Their strategy was clear, and eventually deviating from it was a total abandonment of their core strategy. As we referenced earlier, the persistent and enduring bull market for gold made Barrick less attractive for investors as time went on. Even the long-term SDCs had to eventually be paid off at prices that were no longer advantageous for Barrick. Plus, with the gold market in a seemingly never-ending run of growth and profit opportunity. Other companies without such a robust hedging strategy were able to capitalize on greater revenue and profits, while Barrick was, kind of stuck with those forward contracts and SDCs. Their eventual abandonment of their full hedging strategy meant that they became just another gold mining company. While they are absolutely a juggernaut within the industry, they're now totally exposed to the downturns of the market like their competitors. Lacking their former core competency, they have to strive for more efficient ways to bring gold to the market through exploration, extraction, and the development of mine processes. Formerly, they had been lucky with exploration and acquisition, but were able to ramp up production in a rapid manner that may not have always been the most cost effective. This was okay. Investors were attracted to their stability and limited downside. If they wanted exposure to the highest upside potential, those investors could always find other gold companies that weren't fully hedged like Barrick. Now Barrick can count themselves among those companies. Right, wrong, or indifferent, leadership concluded that they were better off without the large hedging that had previously made them so successful. And maybe they were leading the industry by a wide enough margin in production and diversification with their South Pacific mines that it just didn't matter anymore.